IMF is looking at $650 billion in issuance in SDR. That's peanuts compared to, say, what the U.S. is doing. What's on the table for doing even more? What's enough?
Well, I mean, firstly, I think $650 billion would be very good. We haven't had a new SDR allocation. It didn't happen last year. It is needed. It will be a strong signal of global confidence, global multilateralism. And in these highly uncertain times, when we still have the pandemic, it would help countries, all countries have, be in a somewhat safer position with these additional reserves. Now, of course, this will in and of itself not be enough. And we've talked about the need for concessional financing, especially for low-income countries, but also, debt relief extensions, debt restructuring in some cases. So, there is still a lot more to be done, but this would certainly be a good beginning.
Is this money well spent, Gita, in as much as the biggest impact in these economies will be higher availability of vaccination and greater level of economic activity that flows from it? The SDR story feels like a sticking plaster at the moment. What needs to happen on the vaccination front to get these economies to close the gap?
I mean, so firstly, support has to follow on multiple tracks. It's not just the SDRs, but the IMF has provided emergency financing to 85 countries. There is a lot of funding going into COVAX, which is the main place that low-income countries rely on, the main group that low-income countries rely on for their doses. Again, I think that I agree with you completely that the number one issue to be addressed is vaccinations around the world. We've seen vaccine nationalism of all shades and colors, either explicit or implicit. My hope is that because the total supply of vaccine doses is going to ramp up pretty strongly in these next several months, that people will be in a more generous mood to share. And, it's not so much that money is a problem, but actually just making sure that the production of vaccines, it gets done and that it gets distributed, especially it gets to all the most vulnerable around the world. I mean, that is absolutely essential. So countries have to work together to make that happen. And time is really of the essence here.
And what developing nations don't have is the ability to issue debt or pump more stimulus on their own, with their budget deficits have blown out, particularly in Latin America over the last year. What can we realistically talk about in terms of debt reduction? What needs to happen to bring private creditors to the table to really talk about this issue?
So those countries are in different places. I mean, there are some countries that will need to get more resources at home, increase tax capacity, implementation. I mean, they will have to rely on their domestic resources too. But then, of course, yes, there are some countries whose debt is already so high that it's hard to think of a scenario how they would get out on their own. And for them, debt restructuring is the solution. Here, I would say that the G20 common framework is one mechanism through which that can happen. And we have 3 countries, Chad, Ethiopia, and Zambia, that have all come to, have decided to use this particular framework. So I would say that that's one mechanism to bring everybody, including the private sector, on board in providing relief on the debt front.
Gita, what is the risk of an emerging market debt crisis at this point? And if one country has a problem, how insulated, isolated is it possible to make that country to avoid contagion, do you think? What does your modeling tell you?
So firstly, I would say, just to be very clear, we are not seeing any kind of a systemic debt crisis. We have a world that's recovering strongly, and it is good for everybody when there is high global growth, especially if you're a large trading partner of the US. That helps you. In general, more generally, if you're an exporter, you benefit from it. And we know that, when there are periods when interest rates go up in response to positive news, that's not terribly damaging for emerging markets. But on the other hand, with the faster recovery in the US, if there is a surprise tightening in financial conditions, then that, of course, is a concern. But I'm just going to mention a couple of things, which is, unlike 2013, many emerging markets have much larger foreign exchange reserves, and they have much smaller current account deficits, which is their external borrowing that they're doing right now is not that high. But on the other hand, they are in a deep crisis and they have fiscal needs. So I think, we could see countries that have very high levels of vulnerability, high foreign currency borrowing, high dollar borrowing, that there are risks to them. But again, it's not like we are seeing any kind of a systemic debt crisis.
Gita, there are obvious opponents to the SDRs, and part of it is that that money would be funneled in to pay off non-Paris club members like China. How do you prevent that from happening if that's the route we're going to go in terms of helping emerging markets?
I think this SDR allocation is absolutely essential, like I said, to provide the liquidity protection that is needed in these very uncertain times. We're still not out of the woods, and this is essential. So, you know, in making this new SDR allocation happen, of course, we've also mentioned that we will look into the transparency aspects of it, make sure that it's well used, all aspects. But again, I think for the broader perspective from the global economy's point of view, just having this confidence that there is multilateralism and that countries are working together to support each other, I think is a big plus.
Gita, you said something interesting a moment ago. You talked about the opportunity to take advantage of the recovery, the very strong recovery that we're going to be seeing in the United States. Normally, that would be the case. You would see particularly the Americas, the whole of the Americas, being able to take advantage of such a move. You'd see big commodity producers around the world being able to take advantage of this. How are you modeling this time around differently? That's what normally would happen. But because of the crisis, I look at what's happening in Brazil and I look at what's happening in Argentina, and I wonder whether or not they are going to be able to deliver that same sort of slipstreaming effect that you would normally get this time round.
Yeah, I mean, this time around, indeed, while the U.S. growth is going to help them, they are still dealing with a pandemic and their own domestic problems. So if we look at Mexico, we do have a pretty significant spillover of, positive spillover of the American Rescue Plan to Mexico. And in fact, a big chunk of Mexico's growth has been coming from really strong exports. So it has helped them. But on the other hand, there are other countries for whom financial conditions are tightened. For instance, in Brazil, we saw financial conditions have tightened. So while they do benefit on one hand from the American Rescue Plan, on the trade side, that's almost fully offset by the tightening in financial conditions that they've seen recently, and also because of the pandemic that they're seeing a very large surge in cases and they're having to deal with that. So yes, it's not as simple as just the U.S. growing while the rest of the world just benefits because of the higher U.S. growth.
Well, final question for you. We don't have a ton of time, but I did want to get your take on, as you look forward, what are the warning indicators that you look for? Like, what kind of numbers are you watching on a day-to-day basis?
Well, again, the number one number we watch is everything to do with the pandemic, and especially in use of any kind of new variants, any ones that are going to evade the vaccine. I think that would be a nightmare scenario and would lead to a big downgrade in growth. So that was the number one set of statistics. The second thing, of course, we also are watching is numbers on inflation expectations, because we know that that's going to have an important effect on interest rates around the world, especially in the U.S., and that has implications for all other countries. Again, financial conditions, how sanguine they are. If we see tightening, I think these are the kinds of variables we're looking at.